Good afternoon, everyone. Stocks are in the red. The S&P 500 has dropped a few percentage points over the past week, and this may incite a bit of fear in certain investors, especially since the upcoming earnings are only a month away. I think this is the perfect opportunity to talk about a topic that is not discussed much in investing, which is sectors you should be avoiding. Investors are so quick to tell you that you should be diversifying your own portfolio. You should have a diversified portfolio full of a bunch of companies, but I would tend to disagree a bit with this statement. Now, diversification is good to a certain point. However, I feel like excessive diversification could significantly diminish your returns going forward. Some sectors in the stock market should just not be invested in. I'm going to give you 5 sectors you should be avoiding in the stock market, and I'm going to explain my reasoning on why you should not invest in them. I strongly believe that many investors will have better performance if they avoid these sectors altogether. The first sector you should completely avoid without exception is airlines. Now, this is probably the most obvious one, and for good reason. Airlines have historically been some of the most poor investments possible. I'm going to dive a bit deeper into the fundamentals of these businesses to show you why they are such bad investments. Historically, airlines have always had high operating costs. Low profit margins and high debt levels have also contributed to their poor performance. I want to take a look at a few airline companies and explain to you what makes them such a poor investment. We're going to take a look at one of the most popular examples and a company that's been on the news recently. As y'all know, Boeing is an airline company, and they have returned a measly 5.7% over the last 5 years. Back in 2020, Boeing actually cut their dividend, so you got a total return in the negatives if you actually calculate inflation. So what leads Boeing and all airline companies to have such poor performance? It all comes down to the basic fundamentals of these businesses. Over here, I have pulled up the total revenues for Boeing over the last 10 years. As you could see on this graph, the revenues have not only stayed stagnant over the last decade, but they've also declined significantly. This means that the company is earning less money than it has been over the past decade. Now, I want to see companies that show strength in their market and are gaining market share over other competitors. I want to see companies that are growing their revenues over time. Over here, I have pulled up Visa's revenues over the last decade, and you can see that this company has just been increasing its revenue. This is what you want to see in a high quality business, but a lot of airline companies do not show these strengths. If you compare Visa over here to Boeing's total revenues, you can see it's a night and day difference. One company is low quality and the other company is extremely high quality. But revenues are not the only thing that shows that a lot of airlines are very low quality companies. If you look at the total shares outstanding for this business, Boeing has actually diluted shareholders significantly over the past few quarters. As an investor, this is not something you want to be seeing at all. It means that your piece of the pie is getting significantly smaller. Companies like Boeing and other airline companies need to take on debt to actually fuel their operations. And sometimes taking on debt involves diluting shareholders. A couple other metrics that I would like to show you is the net profit margin for Boeing, and Boeing's net profit margin is in the negatives. This means that the company is literally not earning any money, and for most airlines it's the same case. A lot of airlines go through periods where they're just unprofitable. Now imagine putting money into a business that's not even able to generate a single dollar. That's basically what you're doing when you invest in unprofitable businesses, and yet many investors are doing this. Over here, I have pulled up Visa's net profit margin, and you can see here it sits at a healthy 53%, and its margin has been increasing over the decade. So this is a sign of such a high quality business, and then you compare that to Boeing and most airline companies that are just low quality businesses. And the bad news doesn't stop there. If you look at the free cash flow for Boeing, you're going to see that it's been in the negatives recently. And this is not something you want to see in a business. In my opinion, free cash flow is one of the most important metrics in investing. It means that the company has cash left over after all its expenses are paid. And they could use this cash to reward shareholders via buybacks or dividends. But when a company has negative free cash flow, it leaves no room for investors to get rewarded. And another important metric I like to look at is the return on invested capital. I want to see this number as high as possible. Usually over 20% is very good. So when we look at Boeing, it's even more bad news. You can see that the return on invested capital is at negative 9%. And that's not something you want to see. You do not want to be investing in a company that has negative return on invested capital. All around, airlines are just very poor investments, but you might be thinking that this is just a one-time off thing, and many other airline companies are significantly better. Over here, I've pulled up another American airline, and you're going to see that it's a bit of a similar story. Although these metrics of Delta Airlines is a bit better, you're going to notice that the metrics are still very poor. So you had a compound annual growth rate over the past decade of 4.20%, which is a horrible growth rate in their revenues. You're going to see that the cash flow has been positive over the past few quarters, but it's all around very unpredictable. And the net profit margin is sitting at 5.9%. So the company is profitable, which is a bonus, but the problem is these margins are very, very low. So there's many better opportunity elsewhere, and you should just completely avoid these airline companies. If you go to the return on invested capital, you're going to see that it is a profitable company, so it is at 5.2%, but this is still very low. It's actually below the average for the S&P 500. Airlines are just all around very poor investments, and I would not recommend investing in the airline sector. Adding fuel to the fire, Buffett actually said himself you should not be investing in the airline sector.
I think the airline business has done better because we've sold, and I wish him well. But I still wouldn't want to buy the airline business.
Now, the next sector I think nobody should be investing in is oil and mining. I grouped these together because they're very similar businesses. Many of these stocks fall under the penny stock category, and they provide no intrinsic value to anyone seeking a solid investment. I would actually group in renewable energy in this sector too, because renewable energy is actually a very poor investment fundamentally. A lot of people investing in renewable energy don't seem to understand that just because the energy is the future doesn't necessarily mean that it will make a lot of money. As investors, our goal is to make money, and that's actually the first rule of investing. Don't lose money. So what makes oil and mining such bad investments? Well, it all comes down to basic fundamentals. Usually, these are sectors that are in boom and bust industries. For an example, I'm going to use a stock called ConocoPhillips, which is arguably the highest quality company in the oil and gas industry. What you're going to notice right away is a lot of cyclicality in the share price. Although it has increased nicely over the years, there's many big and significant drops over time, and this just has to do with the cyclicality of oil and gas. Diving a bit into the metrics here, looking at the total operating revenues, you're going to see that they're very cyclical. Although ConocoPhillips has been increasing, a lot of these oil and gas companies have these highs and lows. You're going to see some periods where they go through very high revenues, like in 2022 when they earned $78 billion. But then you're also going to see some lower revenues, like in 2016 when they earned only $23 billion. And the revenues are very cyclical. The problem with this is there's no predictability in the business. As investors, you want to own the most predictable businesses because these are businesses that compound over time and have no significant downturns or significant drawdowns. A lot of the metrics also follow. So you're going to see very cyclical free cash flows. You're going to see very cyclical earnings. You're going to also see very cyclical net profit margins and return on invested capital. So if I look here at the net profit margin, you have years where they're not earning anything. In 2015, ConocoPhillips was earning a negative net profit margin. But all the way here now in 2025, they're earning a 16% margin. So when you have cyclical earnings, cyclical net profit margins, cyclical free cash flows, these are not businesses you really want to own, especially when you want the highest quality companies in your portfolio. It's a similar story with the return on invested capital. You're going to look at the return on invested capital and you're going to see it all over the place. Like over the past decade, this return on invested capital is just so cyclical that you can't predict where it's going to go in the next decade or 2 decades from now. And it's a similar story with almost all oil and gas and mining companies. They get very, very complicated when you analyze them, and they're also in a very cyclical sector. This isn't even mentioning the other problems these oil and mining companies have, which is the political pressures, the political regulations, and the entire world is trying to shift away from oil too. So you have that as a major headwind in the future. So all around, I would just avoid oil, gas, and mining companies altogether. The next industry that should be completely avoided is going to be healthcare. Now, this is probably a controversial one for many people, and I'm going to explain a bit of my reasoning to why I think you should completely avoid investing in any healthcare stocks. This list includes biotech, pharmaceutical companies, hospitals and healthcare providers, health insurance companies, and even medical devices companies. I highlighted this one in green because I do believe there might be some exceptions for medical device companies, such as a stock I talked about previously on the channel called Intuitive Surgical. Now, why exactly should you be avoiding these healthcare stocks? Instead of explaining, I think it's easier if I show you. Now over here, I have pulled up Novo Nordisk's investor presentation, and you're going to see on this earnings report that there's a lot of things that I just do not understand. You're going to see a lot of terms that you probably won't understand, and one of the basic fundamentals to investing in any business is to understand the business and what they do. Healthcare companies are almost always caught up in controversy. Take United Health Group, for example, that dropped over 50% at its lowest point. Just owning a company that is caught up in so much controversy controversy is not something you want to do as an investor. This is just the tip of the iceberg. Biotech and pharmaceutical companies are very cyclical, hospitals and healthcare providers are heavily regulated, and health insurance companies make money off the backs of not giving care to patients. So all around, the healthcare sector seems like bad news. The only exception I would make is medical device companies. The sole reason being is this company here, which is Intuitive Surgical. Intuitive Surgical is a medical device company that has significantly outperformed the market and has very strong fundamentals. I'm not going to do a deep dive of this company in this video, but because this company is so high quality and has very high margins, I feel like it's worth mentioning. However, the healthcare sector should just be avoided. Next up, we have traditional retail. Physical department stores. There's a bunch of reasons why I would never own retail companies, and I actually owned a couple retail companies in the past, one being Ulta Beauty. I wouldn't say investing in Ulta was a mistake on my part. I actually made some money with this company. But Ulta is starting to suffer from problems that pretty much all retailers suffer from. So with many retailers, I'm going to pull up Walmart here as an example, you're going to notice that they have a very low net margin. A net margin of 2.7% for Walmart. Walmart is also one of the biggest retailers in the world, and they have a 2.7% net margin. But the problems don't end there. There's also a very high cost of the store locations, which cuts into their margin. And a lot of these retailers are actually competing directly with Amazon. If you understand Amazon's business model, a lot of small retailers actually have pretty much no chance at competing with Amazon whatsoever. And the problems just add on from there. Some retailers are in the fashion industry, and if you're in the fashion industry, fashion trends could shift quickly. So these retailers have to constantly innovate, and innovation costs a lot of money. So you're investing in a company that has low margins, high competition, high cost involved, and a bunch of headwinds that could cause significant problems down the line. Retail all around is a very bad sector to be invested in. The only retailer I would even consider investing in is Costco. But aside from that, I would not even touch the retail sector at all. The last sector you should completely avoid when investing is any sin stock. So sin stocks could be described as any stock in the industry that is frowned upon. There's a bunch of problems I'm going to get into about investing in these companies, but I actually made the mistake of investing in a gambling company that yielded me negative returns. The sin stock I invested in was called Evolution AB. Now what's interesting about this company is if you look at the fundamentals on paper are perfect. The operating revenues have been significantly increasing. The shares outstanding have been decreasing, the free cash flow has been exploding exponentially, and the net profit margin remains high at 55%. All around, the metrics for this company are pretty much perfect, and it's trading at a 10 PE ratio. But this is where we get into the problem with Evolution AB. Being a sin stock, it faced a bunch of headwinds. Over the last few quarters, there was a bunch of negative market sentiment, and this caused the stock to drop almost 50% over the last year. Even on paper, if the stock was perfect, it still underperformed the market significantly. This highlights the problem with sin stocks. They will always be priced at a lower multiple than other sectors. And this lower multiple does not address some other concerns, such as a very negative market sentiment that could cause protests or strikes, consumer harming behavior like tobacco companies that literally kill their clients, and of course limited growth potential. That's not even mentioning regulatory issues, which these stocks tend to face continuously. All around, it's just a much better option to invest in sectors that don't face any of these problems. If you give me the option to pay a slightly higher multiple on a sector that has none of these issues, I would gladly take that offer. Now, these are the 5 sectors I would completely avoid investing in, either because they have poor fundamentals, poor performance, or just poor market sentiment. I hope this video helped, and let me know if you have any different opinions in the comment section. Thank you all for watching.